Hey everyone, Simon Ree here with a quick video update on what's happening with the S&P 500. So we've got a chart here of the spiders, the S&P 500 ETF, and what's getting a lot of attention is the fact that the S&P 500 is again threatening this downtrend line, which has been in place since the all-time high on the 3rd of January, and the 200-day moving average. Now, the last time we got up here, it was a very easy fade. And the second last time, it was also obviously clearly rejected, and we had a very clear rejection of the trend line back here as well. Now, you can see the last few times we got up here, it was a very good selling opportunity. I think this time is different. I think this time the S&P 500 breaks higher. I think the initial target, well, obviously 410 would be a big one, and if we can break 410, we could get a run all the way up to 430. So let me just share with you some of the differences I'm seeing at this touch of the trend line compared to the previous few, and why I think a break higher is more likely than a rejection of the trend line. The first one is that this is the first time since this trend line has been in existence that the S&P is attacking it without having made a new lower low. So we made a new lower low here before approaching the trend line here. We made a new lower low here before approaching the trend line here. This was the all-time low of the bear market so far before approaching the trend line here, and you can see just here we've made a higher low. So lower highs and lower lows is the very definition of a downtrend. So when we start making a higher low, it doesn't mean we're in an uptrend, it just means that this downtrend, there's a bit of a question mark around it. A second major difference I'm seeing is in relation to the put-call ratio. So let's have a quick look at that chart. Now, put-call ratio just measures how long or short players in the options market are. High levels of the put-call ratio, and I look at the 10-day moving average. When you see the 10-day moving average of the put-call ratio above 1, it kind of means that everyone's got short, everyone's scared, and that's usually when a market puts in a bottom and those shorts get squeezed. Conversely, when the 10-day moving average of the put-call ratio gets below 0.8, it generally means everybody's long, and all of those fresh longs are about to be taught a lesson. So what you'll see here is at this test of the trend line, we had a very bearish put-call ratio. At this test of the trend line, we had a very bearish put-call ratio. At this test of the trend line, we've actually got a very bullish put-call ratio, all right? And what this is indicating is that there are potentially plenty of shorts to squeeze here. And it's potentially going to provide plenty of fuel for an ongoing short covering rally. I'd be way more cautious on the market here if the put-call ratio was sort of down here, but it isn't. It's all the way up here. A couple of other important differences I want to share with you. Let's just jump to another chart here. So the first one, we got S&P 500 in the top panel, and we've got HYG, which is the junk bond ETF in the bottom panel. Now, HYG is relevant because it's a barometer of stress or bullishness in credit markets, and in this case high yield credit markets. And credit markets tend to be a lot better at sniffing out bullshit than equity markets. So if you're seeing problems in credit markets, that's something you want to take note of. Now, you'll see the last couple of times we came up and tested this trend line, HYG was miles away from its 200-day moving average. Now, at this test of the trend line, HYG has actually broken above. Now, you'll see at this last test of the trend line, HYG was also testing its 200-day moving average, and both were rejected. But here, HYG is broken above the 200-day moving average. That, I believe, gives the S&P 500 permission to do the same. Okay, another asset I want to share with you is the S&P 500 versus the dollar. We'll just look at Dixie, the US dollar index. And what I'm observing here is these prior tests of the trend line, the US dollar was in a strong uptrend. This prior test here, the US dollar was starting to trend down, but now we've got a test of the trend line here, and the US dollar has broken its 200-day moving average, and its trend seems to be one of accelerating weakness. A strong dollar is a headwind to risky assets like stocks, and a weak dollar is a tailwind. So it's another difference I'm observing at this test of the trend line and the 200-day moving average compared to the prior tests. Now, nothing in markets is ever completely cut and dried and straightforward, and if there is a weakness in the bullish argument here, it lies in the VIX. Okay, so what I want to show you in the VIX is the last few times the VIX has got sub 20 over the last year. Well, I mean, it got down to sub 20 when we were at the all-time high. Then when we had this test of the trend line, the VIX got sub 20. At this test of the trend line, the VIX got sub 20. At this test of the trend line here, or this sort of region here, the VIX got sub 20. And guess what? We're testing the trend line again, and the VIX is sub 20 again. So the VIX at support is a risk warning, because if the VIX bounces off support and starts rallying, that will only be because the S&P 500 is selling off. Now, one thing that is still in the bull's favor is the fact that the VIX has got a big old volatility squeeze happening, and if this fires short, we could see the VIX start trading in the teens again, and that, of course, would be bullish for the S&P, particularly in the short run. But this is just a good reminder that in trading, we're only ever dealing with probabilities, we're never dealing with certainties, but in my opinion, the probabilities favor the S&P's breaking north of this trend line, challenging 410 initially, with a potential to rally up to 430. That's what I got for you. I hope it helps, and I wish you good trading.